Hey guys, what's going on? It's Denise Donoghue, the Mortgage Nerd. I'm going to talk to you guys today about a question I get asked all the time. How the heck do I buy a house without having to go through the stress of selling my existing one? Well, there's 4 strategies and I'm going to tell you all 4 right now. The first one is the most common one. It is what's called a contingency offer. So you and your real estate agent would write an offer to the seller that says, yes, we want to buy your house, but it's going to be contingent on my current home selling. And that allows you to get out of the contract if in the event your current house doesn't sell. So that's a common strategy, but in the DFW area, the market's been so competitive that sometimes it's not a realistic strategy. So these next 3 options might be an option for you. The second strategy is we can write a bridge loan. And a bridge loan is basically a 2-time close where you don't have to put any money down on the new home purchase. And then once you buy and you sell and you close, you move all your stuff over, and you sell your existing home, we basically refinance that bridge loan into a permanent mortgage loan, probably what you're used to, a 15-year fixed or 30-year fixed, but allows you that stress-free transaction of getting into the house without having to sell your current one. Now, the third option is one that most people have never heard of. And this is what's called the flex loan. This is something that our company offers that not very many mortgage companies do. And we call it flex because it gives you the flexibility of still buying your new home without having to sell and without having to refinance. So here's what it looks like. You still have to have at least 5% to put down. So as long as you have the 5% to put down, whether it's from your 401k, maybe you have a home equity line of credit, or maybe you get a gift of funds from family or friends, we can write a mortgage loan for you to buy the new home, put 5% down, and let's say you move into that house, it took 6 months for you to sell your existing. Well, now it's sold, so you can take that equity from the sale of your home, and we will allow a flex option, which means you can take that equity and put it into the new loan, and we will re-amortize the payment so that your payment goes down. Oftentimes that means we remove the PMI insurance with no waiting period, and it is as if you had that down payment from day one without having to refinance. So it's a great option. We use this option often because it's a one-time close. So for our clients that have at least the 5% down, this is usually the option that we recommend because it saves you a little bit of money and it's super easy to do. So the fourth and final option is you can always lease out your existing home. So you still need funds for a down payment on the new home, but if you're needing to remove that mortgage payment from your debt to income ratios, another option is you can lease that home out. We just get a lease agreement, we get a deposit, and basically that says that we can remove that monthly obligation because you've got a tenant paying it, which isn't a bad strategy because if you purchase that home with a really low interest rate, then all you're doing is you're having your tenant make the payment. They're typically covering the principal and interest and taxes and insurance. The house is still appreciating. So not a bad retirement strategy. It's something that you can always try because worst case scenario, you just sell the house later. So I hope that was helpful. If you have any questions at all, feel free to contact me. All my contact information is online at www.themortgagenerd.com. Y'all take care. Bye.